So, morning everyone, and thank you for joining us for episode 2 of Crowd Powered. That's our new series designed to help you understand what crowdfunding is, how it works, and whether it's a good fit for your business. During each episode, we talk to founders and industry experts about the pros and the cons of equity crowdfunding, and also how it compares to other forms of capital raising. Now, for today's episode, I'm joined by John McKinley from Carey. Morning, John. And Rob Richards from Key Living. Hi, Rob. And we're going to talk about what is probably one of the most hotly debated topics in this space. That's equity crowdfunding versus venture capital. And so over the next 30 minutes, John and Rob are going to share their thoughts on this topic. They're also going to talk about their own experiences with funding and, of course, answer any questions that you have as well. So please do keep those coming in throughout the session. Now, to kick things off, I just wanted to do a quick round of intros with both of you, talking about your experience and your businesses as well. So maybe if I could start with you, John, can you tell us a little bit about Carey, what you do, and also your experience in the funding and the financial landscape too?
Yeah, thanks, John. Happy to join you for this panel today. So I'm the CEO of Carey. I've been with Carey just about a year, which I was introduced to the founders of Carey through a mutual colleague, and really just got super excited about the opportunity to really change the landscape for small businesses, small and medium-sized enterprises. We're a credit card platform that has a lot of feature functionality around expense management, spend management, accounting integration, and also allowing our clients to really kind of control their credit card program within the organization. But also, we're deeply skilled in lending. Several of us have been former bankers and within the small business and commercial space. So we love the platform and see the platform as a great delivery tool to create a new source of credit in the marketplace that frankly doesn't exist today. So that's a bit about us. We're actually in our third round of financing. We've done principally crowdsourcing as our late seed. And also, we did kind of a hybrid sort of model of, family offices, individuals that are founders and several of us on the management team knew and wanted to invest alongside of us, but also did a crowdfunding with front funders, and, thought that was a great experience as well. So that's a bit about me and Carey and what we've done in raising capital in the past.
Great. Thanks very much, John. And I guess same question to you, Rob, if you could give us a quick overview of Key and what you do, and also a bit of your background in the space too.
Well, thanks. Rob Richards, founder and CEO of Key. And prior to founding Key, I was a venture capitalist for 10 years, co-founded and helped run Plaza Ventures. And our mission at Plaza Ventures was to get private capital, family capital into the technology space. And there weren't really many good options to be able to get access to pre-IPO companies for the average private investor. And we knew that crowdfunding would come and help, fill that gap and do it in a way that is effectively managed and governed. Meanwhile, as a private fund, we would go to mostly accredited investors, right? Families with $1 million or more of net worth. And in order to satisfy, governance requirements, and go to them directly and get them to invest, 100 grand, 250 grand into our series of rolling funds, and that's how we tackled our mission of getting family capital into the technology industry in Canada, where there's a tremendous gap. And loved being a VC, loved investing in great companies at seed, Series A, and Series B. And then as I was working within the Plaza group of companies, which is a big real estate organization, and I was witnessing how more of our generation was being kind of locked out of home ownership. You guys, everybody knows what critical issue it is. It's top of mind in media on a daily basis. I found myself in the position to actually do something about it and to bring a new model of home ownership to market. And so I bit the bullet and became a founder again after many years of being on the other side of the table. So I've got that perspective of being a VC and being a founder, really deeply wanting to get private money and the average person to be able to invest in the technology industry pre-IPO. So I've got a really varied perspective around that. And with Key, we've just completed our seed stage financing. We have great VCs on our cap table. We have great angels. And we also have front funder. And part of our ethos is to democratize access to home ownership and to real estate more generally, also from an investment side. And so part of that was we wanted to democratize access to shares in Key. And so it wasn't about the quantum, although we did raise a good quantum with front funder. I'm appreciative of that. It was about bringing the ability to invest in a seed stage private technology company to the masses. And we were very pleased with the response. It was great.
Thanks both for the overview and the intro on the companies and yourselves. Obviously, there's ample experience there, and I'm very keen to dig in and get your thoughts on this topic. It's something that comes up all the time. First thing I wanted to discuss is specifically VC money, and the reason I wanted to talk about that is I feel, and certainly in the conversations that we have at Front Funder, is that for a lot of founders and entrepreneurs, VC money is very much seen as the gold standard of startup funding and source of capital, and everything else tends to come as a second best option or as a sort of alternative. And there's no denying that there are many plus points to VC money. It comes with very deep pockets, so the ability to deploy a lot of capital and to do it very quickly. There's the sort of the industry connections that come with the VC that you work with, so-called smart money. I think also the fact that you're working with people who are experienced in guiding high stage companies and getting that really sort of that growth, and also the stamp of approval. If you get money from a reputable VC firm, it's clear that sort of things are happening, you're in a good place, and it really opens up doors for other things. On the flip side of that, I would also say that VC money is not for every company or not for every stage of company necessarily. So the point being that, VC money is fantastic, there's no denying that, but a lot of the companies that we talk to are perhaps not necessarily ready, or VC money is not the best fit for them. A couple of reasons that come to mind for me would perhaps be the fact of the matter of exclusivity. So I think perhaps less than 1% of companies actually succeed in getting VC money. You've also got the downward pressure on your valuation. There's the fact that you probably need to give up some control in terms of a board seat or perhaps preferential shares. And also there's that constant pressure to grow. I guess there's no such thing as a free lunch. And if someone gives you money, they're going to expect something in return for it. So my question is, I guess if I could start with you, John, what are your thoughts on VC funding for startups? Is it always the best option? Is it good to think of it as the gold standard, or is that a little bit of a mistake?
Yeah, it's a really interesting topic, John. I've given this a lot of thought, and like Rob, I've also been on the institutional side as well with OMERS. And I think you kind of referenced what I think is really important is depending upon your stage of financing. And I'm a believer that early stage companies, whether they're early seed or late seed, and maybe even kind of Series A stage companies, really need to look around a fair bit at different options. And part of it is if a VC really understands your niche extremely well, they tend to get less focused on valuation and maybe a little bit more focused on the management team and how to execute the growth strategy. If they don't understand your niche very well, then you find yourself getting into a valuation discussion, debate right out of the gate. So I'm a big proponent of, early on finding investors who really just want to invest alongside of you. And that's what we did in our early seed. in our late seed. And you know, I did have a conversation because I'm obviously networked into that community. But every time the conversation came up relative to our valuation, it was a no. And we just felt, look, we you know, deeply believe in our business model, deeply believe in our team, and think that we warranted the valuation that we achieved. So, you know, and the other aspect with early stage is, if you're not really in this space and understand what happens, you know, the founders and the management team can suffer enormous dilution early on. And that's a big problem, because you can never, you know, you never get that back as your value increases, and potentially institutional equity owns too much of your business. And then you have a problem kind of retaining and incentivizing top employees. So, you know, I'm a big fan of a different model early on. I mean, in fairness, it was maybe a little bit easier for us because we've got some pretty well-established folks on our founder team and on our management team. So raising money hasn't really been a big struggle. I feel we've been you know, very fortunate that way. But, you know, kind of as you start thinking about later term, and if you look at what's happening institutionally with the convergence of private money coming into, you know, clearly the venture and early, you know, mid-stage kind of venture asset class, you know, the opportunity and the capacity of capital is just enormous. So there's the right time to tap into that when you've got, you know, when you've got a track record, you've de-risked your company, you've de-risked the technology, you've de-risked the product market fit. And what I'm not seeing in the marketplace is enormous pressure on those companies from a valuation perspective. So, you know, I think that's the journey that we like, the journey that we're on to grow and capitalize our business.
How do you see it, Rob? Does that match your sentiments? And I guess also maybe putting on your sort of VC lenses for a moment as well, or that kind of hat. Would you still say that VC money is definitely the way to go if that's available to you and it's a good fit and it's someone who understands your niche and knows what you're doing? Or is it a little bit more complicated than that, and it really comes down to where are you with your business, what do you want to achieve, and how you do it?
Yeah, I'd say it's more the latter. and thanks for that setup, because, you know, you have to think what kind of business am I in, and what kind of company do I want to create? What are my objectives as a founding management team, and things around liquidity? Are we running a lifestyle business? Are we going to be, you know, seeking an exit? And what kind of business is it? You know, if you're creating a technology company that's going to try to be a new category and scale massively, then you're going to need VC support. And in creating that kind of company, you know, crowdfunding was not an option 5 years ago or 10 years ago at seed stage, whereas now it is, and now it can complement your VC activity. It can fill in, you know, if you're in between VC rounds. It can complement or even replace an early stage sort of friends and family round. Now you can go to a crowdfunding platform to get friends and family capital and set yourself up to do a bigger VC financing down the road. What you know, other types of companies, if you're building a consumer product, I think we've seen great success in things like Kickstarter and other, you know, crowdfunding platforms to allow product companies to get non-dilutive funding with pre-orders, and it's been some really interesting results with that kind of platform. So it starts with what is the company? If you want to build something that creates a good, you know, recurring income and you know, becomes a lifestyle business, as we call it, where you're not concerned about scaling massively and you don't want to drive toward some ultimate exit, IPO, or what have you, then crowdfunding is a great alternative to fund multiple stages of growth. So I think it's, you know, first, what kind of company am I creating? What does the management team want? What are our objectives in life? And certainly if you're doing something like we're doing at Key, where we plan to be a massive new category and build a huge platform, sort of the Amazon of residential real estate, we need VCs. We need VCs that understand how to do that, that are in the market, that give us that credibility, and can do $100 million, $200 million, $500 million financings as we scale from B, C, D toward an IPO eventually. So you have to take all those factors into consideration. But what's really cool is that now crowdfunding is a viable alternative. And you've got really good platforms that are professionally put together, that manage investor relations, and manage governance, and manage communications, and manage your shareholder base. Where before, the thought of taking on 150 shareholders was such a daunting task, because you have to manage that in a spreadsheet and use email to communicate to everybody. And then how do you get a shareholder vote to happen? All of that's just so difficult. But now with crowdfunding coming into its own and being a mainstream alternative, it's just a wonderful thing for entrepreneurs to have in their book of options.
I think that's a really interesting point, and you're both kind of touching on it there. That it's maybe pitched as, and we did for this event as well. Kind of is it a versus? It's very much an either or. But the narrative is much more a complementary thing. I think, like you said, Rob, that it's what stage you at and what are you doing, and kind of what is the best fit at that particular stage. And I think I know another thing, John, you also mentioned to me when we were discussing this, is the idea of sort of optionality, having different things that can appeal to you at different stages and that work in different ways. As you said, Rob, you want to go to that sort of huge international growth. You're going to need some VCs or someone with deep pockets. But depending on the nature of what you do or how, it's also good to open it up to everyone and give them kind of the chance to invest. So I guess a question to you, John, when you were kind of considering equity crowdfunding for Carey, what are the things that mainly stood out to you that made you want to do it, that thought, yes, we want to run a crowdfunding campaign alongside the other things that we're doing? What are the main things that kind of drew you towards equity crowdfunding?
Yeah, I mean, I think Rob referenced this a little bit earlier as well. I mean, one of the key things is clearly this trend towards democratization of capital, and we're very much about the democratization of capital at Carey. We're trying to introduce new sources of capital into that small business space where it hasn't existed in the past. And so it's kind of in our DNA. And also, we deeply believe at Carey, and I personally deeply believe that private investors should have this, should have some opportunities to jump on board as some great new companies. And they would otherwise not have access to the asset class. The rich get richer, and people who want, do their homework, want to do their own investing, should have access. And I think our regulatory environment has opened that up and sees the merit in that. And Fund Funders is a great example of an organization that did diligence on us, as you do on all of your the entities on your platform. There's a proper process, a proper securities process. And interestingly, a lot of people have reached out to me who've invested through Fund Funder. We're our investors of Carey, and there's a lot of very professional, people who are in the private equity industry or in the financial services industry or capital markets who, invested in Carey. So, I think there's just an appetite out there. Everybody should do their diligence and make sure they understand the business, but I just think it's the right thing to do for the sector and for individual investors.
If I could add to that, I'd like to quote Wayne Gretzky in this way overquoted line in Canada especially, but skate to where the puck is going. And for us, that's really why we decided to engage with Fund Funder. Democratizing access to Key's shares early on, that's our ethos. But we see, mainstream global investor, everyday person investor access to not just digital securities, but digital assets, asset-backed securities, as the thing that's really going to come into its own in the next 10 years. And I think companies are going to have really new optionality open up where you can float or raise across jurisdictions as the regulatory environment, kind of congeals and becomes more homogeneous. And that's going to be fantastic. You could float either, a non-dilutive kind of product-oriented security. You can float a preferred share. You can float a common share. You can do these things on these platforms and access a very wide audience of prospective investors and do it where it's all fully managed. And again, you're not using spreadsheets and emails, but you've got a functioning platform to do all of that for you. And that's going to be amazing. So I see the future of crowdfunding as being very, very bright, giving all kinds of optionality and all different classes of securities, and it's going to get super interesting. And so we wanted to be on that sort of first wave and understand it, participate in it, and prepare for what's to come.
That's another point that often comes up with, I think, founders or entrepreneurs looking at the two options. That I wouldn't say equity crowdfunding is perceived as messy, but it can be a bit daunting to have, another 500, 600 sort of shareholders. I think John mentioned that you can see that as a positive or a negative, right? You can have the kind of the wisdom of the crowd, or there's 500 people within there. You will have some sort of first-time retail investors dipping their toe into investing, but there'll be some pretty seasoned and experienced people there as well. And I think another thing, Rob, that you and I discussed kind of prior to this call was that angel investing in itself, you can have probably up to 50 people on your cap table anyway, I would assume, when you're raising money for a VC anyway. And as you said, equity crowdfunding forces you to do good due diligence anyway. You don't just kind of go ahead and list. There's a lengthy process to it. Could you talk me through a little bit sort of how you see that with sort of from a VC perspective? Like equity crowdfunding is sort of something that, well, you've done your due diligence, you've done your homework, so it's actually a good thing. It's kind of a thumbs up that you're on the right track here with your business. Or how is that perceived? When you have those 700 people, one line covered by a voted trust agreement, but how does that perceive from the VC side?
Yeah, I think it used to be something that might have been a negative. If you had, a couple of hundred shareholders in sort of early rounds, VCs would look at that and go, "Ooh, you're going to be a governance disaster." And, how can we impose a kind of a new shareholder agreement that has certain rights and protections that we need as a VC that, you don't want to confer on the 300 shareholders already on the cap table, right? And so you get into issues of governance and organization that could get messy. I think now with crowdfunding being really buttoned down and the platforms imposing really good diligence and really good governance and things like voting trusts where future shareholders, big VCs don't have to worry about your ability to command a shareholder vote and get things done. That's super, super important. And so I think where the industry is now and certainly where it's going, we see them being very compatible, and VC shouldn't worry about it. They should actually like it, because as you say, to do a crowdfunding now, you've got to go through extreme diligence and you've got to implement governance in a way that is going to set you up for success with VCs. So,
and John, I know that Carey has very big plans over the next couple of years, and you're looking to raise more money as well. Does that match the reception you get when you talk to larger investors that potentially back you? What's their reaction when they see that you've done a crowdfunding round?
Yeah, I wouldn't say that it's caused us any issues with any of the institutional investors that I've talked to. Again, it's really important for us to retain optionality. So, as we think about a Reg A in the US, I would say some institutional investors, don't like it because of the reasons that Rob kind of talked about. And I think the messy cap table issue, I don't think that's a reality anymore, as was discussed. But it's more, just kind of a matter of will they be able to kind of step in and set the terms and conditions that they want, if we've got a hybrid kind of model between crowdsourced and institutional investment. But we always have to be aware of that and thinking about that and thinking about it for future liquidity purposes. But having a number of investors, a large number of individual investors in your cap table, gives you a different kind of optionality around IPO as well. So it's really important to us that we retain optionality and that we can drive the business the way that we want to.
I would add one more thing, which is you see a lot of VC funds now that are actually crowdfunding, right? You talk about the two worlds coexisting. Well, there's a shining example of that.
Yeah,
right?
Yeah, it's a good point. Good point, Rob.
That's an incredibly interesting one, because I think 10 years ago, it was almost sort of like a David and Goliath, where you have this sort of upstart alternative form of funding kind of challenging VC. Crowdfunding has grown a lot over the last 10 years. The pandemic, I think, accelerated that to a degree. But as we touched on, and as you're saying, Rob, it's not an either or, it's more a complementary sources of funding. I think, Passion in the UK did part of their fund on Cedars, I believe. Backstage in the US did part of their fund on Republic. So the future is very much hybrid. And I guess just to wrap things up for this session, and a question for both of you, I guess you mentioned it already, Rob, but kind of we need to move where the puck is going. So where do you see equity crowdfunding fitting into the future of startup finance? Is it still going to be a case of VC money is the gold standard, and then comes equity crowdfunding, or is the narrative changing now, and it's more very much a case of it's what works for you at what stage, or perhaps you will go through both at some point in time?
I think you'll go through both at some point in time. I think more and more companies will use both, we're headed into this blended hybrid reality where optionality, the ability to access global investor bases at the flick of a switch, different types of securities that can be supported, to some non-dilutive, some dilutive. All that optionality is just a great thing, and so I'm very bullish on the industry and on getting access to tech companies and other types of companies to the global everyman. I mean, that's where we need to go. We have this incredible wealth gap in society, and as you say, the rich get richer, and we've got to put an end to that and allow for broader participation.
Absolutely. How do you see it, John? What do the next 5-10 years look like from your perspective?
Yeah, I would view it the same way as Rob, John. I think that there will be an emergence of a hybrid model. I think it does become very stage kind of sensitive, and as we talked about, the type of company that you want to be. But if you're a high growth trajectory company, getting early financing, early seed or late seed, maybe part of your Series A from crowdfunded is a great mechanism, and I think it really is where the puck is going.
Fantastic. Well, loads to go through and lots of great insight shared on the session today. A huge thank you to both of you, to Rob and to John, for joining us today. Really appreciate you taking half an hour of your day to talk with us. And a huge thank you to everyone who tuned in from home as well. Hope you found the session interesting. We'll of course follow up with an email in the next few days with the recording and a bit more information. We'll be back next year with episode 3. But yes, thank you very much, everyone. Wish you all a fantastic day and a very happy holidays. Take care and see you all soon. Thanks.
Thank you.
Thanks, John.
Cheers.